Hello, everyone. I'm Neil Watson, one of the financial advisors here at Commonwealth Financial Services. In a moment, I'm going to be joined by Daniel Spurgeon, and he and I will kind of go over and recap what's happened over the first half of the year in the investment world. Looking ahead to our Wealth Wednesday episodes coming up next week, we have a show about the go-go, slow-go, and no-go retirement years. And the week after that, we are going to talk about safe withdrawal rates. The following week, we will be introducing our new financial planning residents, and that is Madison Gontarek in our Parkersburg office and Corey Kloss in our Wheeling, West Virginia location. Let's kind of get into a review of what has happened over the last 6 months, the first 6 months of this year. And it's been a slightly better year than maybe you might have thought in the course of things. And we'll see if we can pop some graphs up here on the screen. The NASDAQ, which was hit extremely hard during 2022, has rebounded almost 38.7% through June 30th. The S&P 500 is up nearly 16%, and the aggregate bond index is up 1%. When we look at it from the standpoint of this bear market or the recovery as a whole, bear with me here a second. When the bear market has extended for 543 days total. The drop was minus 25.36%, and we are up 24.3% since then. Now, one of the things you have to remember is a 25% increase does not erase a 25% decrease. It actually takes about a 33% increase to eliminate that. So we're still trying to climb out of this hole a little bit. As far as bear markets go, this bear market has lasted for 543 days, as we said, 282 days to the bottom. And so far, we're about 263 plus days to trying to get back to even as a whole. And we're making progress, but it has been a little bit difficult at times. One of the things that's kind of interesting about this bear market, and Daniel and I will talk about this here momentarily, is this rally has been led by very few names. In fact, it's mostly the top 10. The equal weighted index, S&P 500 index, is only up about 6% through June 30th. And the broad index is up almost 16% over that same time frame. So it's been a challenge for a lot of people to kind of figure out what's going on with that. So it's not really a broad-based market increase. It's been led by a few handful of names. Daniel, welcome to the show today. We've just been kind of covering what's happened in the broad markets as a whole, and the fact that this market's been led by just a couple of names, 10 or so, has been kind of challenging for investors.
Right. Yeah, you've got the way the S&P 500 is weighted. Your major tech stocks, most of which that got beat up pretty badly last year, have really, really ripped back this year from the premise of the initial estimation of a rate decrease late this year, early next year, and then obviously the artificial intelligence news that's come out. So those large tech stocks have done very well, which has driven the market up, but the breadth of the market's not really been there.
Sorry, I'm having a couple technical difficulties, not able to hear you real well. So I don't know if anybody else can hear Daniel or not. I'm not picking him up.
Let me check my microphone here.
So anyhow, when there's only a few names that are leading the charge, and you have a more conservative portfolio, things don't look as good as they tend to when you look at some of these types of statistics. It becomes more of a challenge, and there are some difficulties with that, and from a psychological and mental point of things. You get it? Okay. Well, I'm being told that Dan is good or was good.
Can you hear me now?
Yes, I got you now. All right. So just talking about the fact that the index has been led higher by a few names as opposed to the, just a broad-based rally as a whole. And that's causing some mental anguish, if nothing else.
Yeah. What I had said, and if the viewers could hear me, I apologize for being redundant, but you hit the nail on the head. You had your tech stocks last year. There's been eight or nine companies, I think I read yesterday or 2 days ago, that have made up 92 or 93% of the return of the S&P 500 this year. Your Apples, your Amazons, Googles, Microsofts, Teslas, Nvidias. A lot of those last year were down 25 to 45%. So they got really hammered last year as interest rates were increasing. The market initially was pricing a rate reduction in Q4 of this year, which obviously the Fed in the last 2 weeks has squashed any hope of that happening at this point. And then obviously with artificial intelligence news coming out, regardless of how far out that may be as far as implementation and actual effective use, those large tech companies are the front runners of the AI frontier. So their stock prices have really rallied this year. And the way that the S&P 500 is weighted, those, 8 or 9, 10 companies make up 25% of the overall weighting, and they're all up between 40 and 200%. So they've done exceptionally well.
The AI boom is something that people are looking forward to. And I've read several places where they believe it is the next major innovation in the world and could be the start of the next major bull market, kind of like the tech bubble or the tech boom was back in the late 90s that ended up turning into a bubble. How is that impacting the market as a whole that you've seen?
Well, again, this year you had very preliminary, I guess, news. There's been some implementation of artificial intelligence, but the full scope or how that can be implemented in, I guess, all different sectors, not just what we consider the tech sector, but how will that help manufacturing, right, and or hurt the job market potentially as additional the workforce may shrink. The physical workforce, as far as human labor, may shrink if it actually is implemented effectively. How will that help? How will that help manufacturing, logistics, energy production, right? And I guess that remains to be seen, right? So the market's definitely initially, and I say the market, some of those large tech firms have really jumped early this year due to that news. But none of us obviously really know the full effect or impact or the time horizon for the full implementation of what AI will do. But I think there's definitely the prospect of this could definitely change the outlook. It'll be a market disruptor for a lot of different industries and sectors, depending on how it's used and implemented.
Yeah, there's even some concern on our end that it could disrupt our industry to a degree. I think it's going to help our industry a little bit as well.
Mm-hmm.
But some things there, and I had an interesting statistic here that the Bureau of Labor Statistics indicated that 92 million Americans changed jobs in 21 and 22, which is absolutely incredible. Bear markets are difficult to recover. And I'm going to put this slide back up here if I can get it working the way I want it to. We've seen some longer ones than what we have in years past, but this one is by far not particularly bad from a duration standpoint. Of course, that one from 73 to 80 was really a lost decade, but comparatively speaking, it's not nearly as bad, but it still weighs on the mindsets of our clients. And you've been through a couple of these. How's this one been different to handle from a psychological standpoint?
I would say the most challenging part is since 2008, we've had two truly negative years, and that was 2018. The S&P 500 was down roughly 6%, and then last year the S&P was down roughly 20. So if you go from 2008 to today, or 2009, should I say, to today, with the Fed keeping interest rates low and pushing the envelope as far as a monetary easing policy, that's really stimulated economic growth and stimulated the market. Some would argue artificial stimulation, but that's a different argument for a different day. We as advisors, and I think clients as well, have become accustomed to not really having to pay extra attention to allocation, and everything has just really gone up for 13 years, 14 years. So it's been kind of a emotional check, if you will, of it doesn't always just go up, right? It's normal. It's normal if you look back 60 years and 70 years to have periods of volatility and periods of 10, 15, 20% pullbacks. And as that chart illustrated, this is far from, one of the worst pullbacks we've seen or extended durations of a recession or a down market. So I think it's just been kind of resetting the psychological side of, hey, this is still normal. And two, I guess it plays in on the psychological side of things is more and more people are connected now via social media or access to the media than ever before. And, bad news sells. So there's a lot of negative narrative out there. And I get, clients this year say, oh, the market's terrible. It's up 15%. So it's, it's not been fun the last 18 months, but the last 4 months have been pretty solid. So yeah, it's fighting the news stories is always fun as well.
The outlook as we go forward, there's still people, experts, pundits, whatever you want to call them in our industry, that talk about the still possibility of a recession. I think we've seen some downwards earnings revisions. There's some slowing economic data and things like that. And I know we just had a discussion with another investment manager yesterday, and they were very vague in their outlook. They didn't really have a lot to say. When I talk to clients, there's a lot of concern about what's going on in Russia, what's going on with the economy. Is it really slowing down, the employment news and things like that? What's one of the best things that we can do as we look into the second half of 2023 and really several years beyond?
Well, let's focus on what we can control. So planning, right? We've emphasized that a lot on these podcasts and these videos previously. None of us in our industry have a crystal ball and know where this thing's going to go. And, if we're headed into a recession, is it going to be a mild 3 to 6 month recession, or are we truly headed into 3 to 5 years of economic slowdown where you see the S&P average 5% a year instead of 12? We don't know. So that's where we really emphasize planning, and we always make, as a practice here, conservative estimates on returns. So, we don't want to show a retirement plan or a financial plan for whatever the goal may be or the time horizon, a client averaging 7, 8, 9%. You very well may, and we sure hope you do, but we don't want to make aggressive bets on the one factor that we don't control, which is the equity markets. So I think planning and looking at where your financial position is today from a cash flow analysis, tax analysis as the tax climate changes and interest rate climate changes, looking at how much risk you're taking in your portfolio, and again, projecting forward. If we continue to average 3 or 4 or 5 or 6%, are you going to continue to be able to reach your goals in the time horizon that we've initially estimated, or at a certain date? And that's where, just having candid conversations with clients about, look, let's focus on what we can control. And then we can always try to tweak the portfolio based on, as you said, very vague at this point in time. No one's taking a firm stance on, right, we think we're headed into a recession or we're not, right? We still have an inverted yield curve. Short-term bonds are yielding more than long-term bonds. And, I had a professor once that said that the inverted yield curve has predicted 9 out of the last 5 recessions. So,
yes.
Not always a telltale sign. It has preceded every recession, but it doesn't always mean we're headed into a recession. So, there's definitely a lot of factors that would point towards an economic slowdown. But does that mean we're going to see another 30% drop? We don't know. We doubt it, but it could happen. And that's where I think risk management and planning really come into play.
So one of the things I think is key is to always maintain an optimistic outlook towards the future. The short term tends to look dire no matter what lens you look through it. But when we look at things over long periods of time, whether you're talking hundreds of years, decades, whatever the case may be, things have steadily improved, and companies have continued to find ways to increase their earnings, innovate, become more productive. People tend to earn more over their lifetimes. We've seen a significant jump up in wages throughout the country, and it's a good thing for all of us. Whether it's AI, whether it's some new technologies in the renewable energy space, there's frontier things that are always happening that are always going to make an impact, and we oftentimes don't really know what those are going to be. And there's a certain amount of blind faith that comes with being an investor, regardless of how aggressive or how conservative you want to be. You have to believe that the stocks are going to act like stocks. And we accept the downside with that, but there's also a lot of upside there. And how fast it goes up is anyone's guess. But I have the strongest belief that we're going to see things extend beyond where we are right now. I mean, the market has never not gone on to set new highs. Speaking of the planning thing, and I want to share this number with you that I got here from First Trust. There's a company called Capitalize, and they reported that the number of forgotten 401k accounts left behind when an employee switches the company they work for stood at nearly 29 million in May 2023. That's a 21% increase from May of 2021. And they believe it's from the spinoff of the Great Resignation, as we talked about, the number of people who changed jobs. Oftentimes those orphan 401k plans can be long forgotten. Why is it important for people to keep track of that stuff?
I mean, well, one is just, again, keeping track of it. Just, I've had clients come in and, 20, 25 years after they've, moved on to a different company or two different companies, three different companies in that time horizon. And, we're humans. Life happens fast, kids, grandkids, retirement. And when you're looking at the big picture of retirement or whatever your financial goal may be, we always talk about retirement, but it could be anything from buying a new house, funding a child or grandchild's college, whatever it may be that requires financial resources. If you have a retirement plan 20 years ago, you very well may not remember exactly who it's through. You may remember the employer, but then the employer may have moved the plan from a T. Rowe Price to a Fidelity to a Lincoln to a Prudential, right? The plan sponsor, the employer, has the right to move that plan from trustee to trustee, if you will, or plan manager, if you will. So, from an organization standpoint and just keeping a thumb on the pulse of your overall financial picture, it's difficult to do if you don't have an idea of where everything is. And oftentimes aggregation and having everything under one roof makes that incredibly easy to do. And a giant misconception, and we see all the time, I'd be remiss if I don't hit on this, is the argument of diversification. So if you've got your assets at 4 or 5 different institutions, whether it be banks, financial planners and advisors like us, old 401k plans, that is not diversification. You could have money at 6 different institutions, and if it's allocated to the same types of investments across all 6 institutions, there's no diversification. You still have high correlation of risk and volatility. So diversification comes from the type of investments that you're holding and the strategies that the money is following as far as an investment strategy goes. Institution doesn't change anything. So that's a common misconception that I hear all the time is, well, I'm going to leave money there because it's following a different strategy. No, it's not. It's doing the same thing your other 4 or 5 accounts are doing. So, we encourage folks, even if you don't want to have it managed and you don't want to have a fee on it, put it under the same roof. And if you want to manage it yourself, that's fine, but at least you can see it. And you don't have to chase 7 different custodians down.
Yeah, I mean, that's an excellent point, because oftentimes if you know, if you want to have a play account, right, and you want to chase a bunch of things, then whoever is helping you with that needs to understand that level of risk in your account so they can adjust everything else to account for that. Let's shift gears a little bit. And we've talked about some of the more conservative things. I know we're getting decent rates on CDs and everything. And I know we've had some internal meetings uh, ourselves about the hurdle rate, as Mike likes to call it. You have a much higher rate that you have to earn in risk assets compared to some of the lower risk assets like CDs or treasuries or things like that. How does that impact allocation decisions at our level?
Yeah, I mean, again, real quick on that. I mean, we still have you've got CDs and money markets, high fours, low fives. But one thing to keep in mind, my dad always likes to reflect back on the 70s and 80s when you could get CD rates at 8, 9, 10%, but inflation was 12, mortgage rates were 15. So it's all relative. We always want to look at real rate of return. I don't care if you can get 5 in a CD. If inflation's 5.25, you're still guaranteeing yourself a loss as far as purchasing power goes. And again, we tell clients this all the time. We're not arguing that you should not have money safe for an emergency fund, accessible. You do not want to have all of your assets in the equity or bond market, because you have to be willing psychologically to accept the fact that some of your money is losing to inflation because you have it liquid and accessible there for an emergency fund or a rainy day fund. But so that's, I mean, yeah, we were absolutely having the conversation with clients of, look, can we go get 5 or 6% in fixed income, or 4 or 5% in bonds, short-term bonds, or CDs or money markets? Absolutely. And a lot of the times we're using that as more of a cash management tool versus leaving it in the savings account at a bank that may still only be paying 1% or sub 1%. We still do see that. So is there a way that we can take some of that money without exposing it to equity risk and still get a decent return, better than sitting and doing absolutely nothing? But yeah, I mean, and again, I don't mean to take a long-winded answer to a short question, but if you're still looking at keeping up with inflation and earning a positive real return, which is your gross return minus inflation, equities are still the only vehicle that's consistently done that over history, right? So the hurdle rate on a statement is absolutely higher right now. Hey, I'm getting 4 or 5 without taking equity risk. But you're still really losing when it comes from an inflationary perspective. So, it's just trying to balance the psychology behind that with clients.
And investing's half mental, and
I think it's 75 to 80% mental at this point. So yeah.
It's probably 90% mental most of the time. I mean,
right.
We've seen lots of things about investor return and investment return in our industry, and there's a stark difference between that. And usually it's the mental side of things that cause the problems. Dan, we're kind of running along here. What can you finish up with today?
As I'm always a huge advocate for planning. So anybody that watches these when I'm on here, not that the investments aren't important, but again, as a fully admitted control freak, I really do try to emphasize on let's focus on the variables that we as a team, us with our clients, can control. That's savings rates, risk level, planning, goals and time horizons, quantifiable goals, right? Make it very easy to lay out and say, look, is this reasonable or is it not? The market's we've started, joking to say the market's going to market. It's going to, if you look back historically, the standard deviation or volatility of the S&P 500 is between 17 and 18%. So if you look at a 5-year or a 10-year sample of returns, if it's averaged 9.5, great, but it hasn't hit 9.5 every year, every other year, there's a 17.5% dispersion amongst returns over that time frame at any given time. So we don't know when the cycle and or sequence of returns and how they're going to hit. We know over a long period of time, your probability of being positive increases dramatically. And when I say long period of time, you get over 5 years, your probability of being in the positive is very, very good. You go 10 years or longer, there's never been a period since 1900 that the S&P 500 is negative over a 10-year period. So again, focus on what we can focus on and control, and then know that the market over the long run, as you hinted on earlier, Neil, is companies are always going to innovate. The market's always going to go up. If it didn't, we're going to be out of a job. Money won't matter, and no one would invest. So yeah, that's focus on what we can control, and that takes away a lot of the anxiety and stress that clients face of, when we go through a down market or a sideways market and you're 2 years, 2.5 years into very average returns or below average returns. Are you still okay? Are you still on track?
Yeah. Are you seeing any consistent themes when you're working on plans, any significant opportunities that clients maybe haven't been exploring?
Tax management, right? That's something we've recently hired a new advisor, and she's sitting in on a lot of my meetings, and she made the comment the other day that that's one reoccurring theme, for multiple meetings with clients is tax strategies. Uncle Sam's always going to be our business partner. It's just, how do we try to make sure that he gets a mitigated or as small of a share of the profits as possible? Right. So looking at, tax rates where they are today versus historical averages, knowing that tax rates are going to go back up in 2025 as the 2018 tax reform will sunset in 2025. And that's not counting any legislation change that could push rates higher in the future. That's stuff we don't control. Again, the government's going to do what the government's going to do. But we have to look at opportunities for Roth conversions, or moving money from account to account, depending on someone's tax bracket. How do we take money from a pre-tax account versus a tax-free account? The estate side of things really plays into that, as required minimum distribution rules have changed for inherited positions. Mm-hmm. So taxes, again, a lot of folks come to us for investments. Investments are the last thing that we actually control the outcome. Where I think we add the most value is the planning side of things. And, I personally pride myself in tax mitigation and tax planning, with an accounting background, and working in taxes for a few years prior to joining this industry. My goal is to mitigate what a client has to pay. We're going to pay something, right? We're not into tax avoidance. That's how you end up in jail. But mitigating what you legally owe to the IRS, and that may be across multiple generations, is the best way to plan for that. But that's something from a planning perspective, Neil, that is consistently coming up, is how do we manage tax burdens?
Yeah, we're seeing the same thing when we're working on things as well. The Roth conversion opportunity is very interesting and intriguing, and it's one of these things where you have to think in terms of not today, but multi-generation, the next generation down, multi-years. The goal is, how can we send the government the least amount? And that is really what we've started to notice and focus on, part of these plans. And there's a real sweet spot between 65 and 72, 73, or 74, depending on how old a person is, because the RMD rules have changed. That's kind of a narrow area where you have this opportunity to potentially convert some of those pre-tax assets into really tax advantaged assets in the longer term. And that's a great segue as we follow up here a little bit. We have a lot of knowledge and expertise on staff. Dan is an extremely bright guy, and there are several others that join him. We can understand as well as anybody else how money is codependent on everything, how it intertangles with itself, and understand how it all works. So if you'd like to have someone help you work through some of those details, you can find Dan, myself, or any of our other advisors at CFSWD. We'd like to thank everybody who tuned in today, and we will put a replay of this on our website. Thanks for watching. Have a great day.